Good morning to all. Today we had an interactive session with Dr. RKMohapatra, where he shared his insights on various topics related to investment products, risk and reward, and investment strategy. Before starting the interactive session, let me introduce our esteemed speaker, Dr. RKMohapatra, a professional cost and management accountant, blogger, writer, speaker, social activist, and award-winning best-selling author with 34 years of experience in finance and accounts. Dr. Mohapatra is a fellow member of IRCON and currently serves as the Vice Chairman of the Jammu chapter. His international recognition is further solidified by his membership in the UK's Chartered Institute of Public Finance and Accountancy. Welcome to the Smart Money Maneuver channel. In this session, we will cover the following topics: investment avenues, risk and returns of various products, benefit of investing in mutual funds and direct stocks, power of compounding and its magic rule, and many more. Disclaimer of Smart Money Maneuver channel. The information contained in this channel is for general purposes only and not investment advice for any investment products. The views expressed are only constituent opinions and therefore cannot be considered guidelines, recommendations, or professional guides. It is discussed only for educational purposes. Hello, sir. Please provide insights into various investment products and their rates of return. How does the power of compounding work in our investment journey?
Good morning. Thank you for your kind compliments. In today's sessions, we will discuss various investment avenues along with their associated risks and returns. To cover how compounding works in your investment and the ways to create long-term wealth. There are investment vehicles. Basically, there are 5 to 6 types of investment vehicles. Rather, we can say that it is an asset class. These are commodities, equity, debt instrument, real estate, and insurance. Insurance, so far as ULIP is concerned, we can consider it is a investment product. Otherwise, insurance is not a investment product. As I told, there are different asset classes. Each and every asset classes has certain rate of return and certain rate of risk. They differ from one asset class to another asset class. Say, for example, you are investing in a bank FD, that is a debt instrument. The rate of return, what you are expecting on today, is generally 7 to 7.25%. Whereas the same amount, if you are invested in equity, mutual fund, or direct equity, you can expect that the different rate of return. It may be 20%, it may be 50% in direct equity. For so far as a mutual fund is concerned, it will vary from 12% to 24%. That depends upon which asset class you have invested. So far as the commodity concerns, you can invest in gold, e-gold, gold ETF, silver ETF, silver, physical gold. Apart from that, you can also invest in gold funds, which is available in the mutual fund route. In equity, you can invest in direct equity by opening a demat account, or without a demat account, you can go through mutual fund and there you can invest equity. Mutual fund is a wide market and it is consist of both debt as well as equity. Some funds are purely equity oriented, some funds are hybrid in nature, that is some 35% is equity, 65% is the debt, reverse same, 65% the equity and 30% debt. In conservative debt fund, where 75% equity, 75% debt and 25% the equity. In debt instrument, you can invest in post office deposit, bond, RBI bonds, debentures, senior citizen schemes, government securities, and for real estate, you can invest either land or building. Apart from that, today currency also is a asset class. You can invest in currency also. All these investments are based on some investment criteria. What are these investment criteria? Basically, there are three types of investment criteria when you are doing the investment. First one, the security. Second one, the liquidity. Third one, the yield. You see, there is an inverse relation between security and yield and liquidity and yield. How? If your investment is more secure, your yield is less. If your investment is more liquidity, then your yield is less. Say, for example, you are investing in a PPF government-backed 15 years exempt scheme, which is fully secure because it is the government-backed. In the reverse, the yield is only 7.1%. If you invest in a liquid fund where the yield is very less, 6 to 5% annum. That means more is the liquidity, less is the yield, more is the security, less is the yield of the product. Let us see what are the risk and return of investment products. Suppose it is a saving account, you will earn only 3 to 4%. Suppose it is a fixed deposit, generally you will earn 6.5 to 8.25. That depends upon which bank you are investing. Suppose you are investing in a PSU bank, then you are earning only 7%. In a private bank, you can earn 8 to 5%. Apart from that, you can make fixed deposit in the NBCC like Bajaj Finance, Shriram Finance. There you can get 8 to 5%. That depends upon the horizon of investment. In physical gold, it is high risk in nature. The investment is 7 to 8%. In ULIP, it is high risk because it is invested in the equity, but yield is very less, 4 to 5%, because due to upfront commission, this product is not generating more returns. So far as equity is concerned, you can expect 20 to 25% or 20 to 50%. That depends upon the stock where you have choose. If it is a large cap, say SBI or Reliance or HDFC, it is a 20 to 25%. If it is a small and mid-cap size company, then you can expect 40 to 50%. That depends upon the market condition and the market trend. It is not guaranteed. Equity return is not guaranteed. It is depend upon the market conditions. In equity mutual funds like equity, that is a medium and high risk, you can expect 12 to 18%. That depends upon which fund you have invested. Same in the debt mutual fund. As it is a debt in nature, the rate of interest is very low, 8 to 10%. In a liquid mutual fund, rate of interest is 4 to 6%. A land and building, that depends upon locality where you can invest. Suppose you are investing in Bangalore, someone is investing in a small town in Jammu or say Punjab. In the Bangalore, the appreciation of land or appreciation of flat may be more than in comparison to the other town in Jammu or Chandigarh, whatever may be. Then whenever you are choosing a land or building, you have to see the locality. So far as the PPF is concerned, you have to earn only 7.1%. In last 4 years, there is no change in the PPF rate. Government is declaring in every quarter the small savings schemes rate of return. But since last 4 years, there is no change in the PPF rate. It is 7.1%. For bond and non-convertible debentures, it is a low and medium risk product. Here you can earn 7 to 9% of the rate of return. Depending on the rate of return, expected annual return, you can make a portfolio. For long term, you can go to equity and equity related products. And for short terms, you may prefer to deposit in bank fixed deposit or saving account or liquid funds. For long term, 10 years and more, you can choose equity or equity mutual funds. Let us see SIP return of and power of compounding. Make a SIP of 5,000 per month and expecting return 12%. Over the 20 year, you are paying 12 lakhs and your final amount will be 46.52 lakhs. In the same SIP, if you continue further 5 years, say 25 years, that means you are adding 3 lakhs, 5,000 per month, per annum 60,000 for 3 years, 5 years, that is 3 lakhs. Then your investment amount will be 15 lakhs. But your total fund amount accumulated is 86.05 lakhs. That means you are paying 3 lakhs, you are earning 40 lakhs. Suppose you continue in the same fund another 5 years, up to 30 years, and expecting the same rate of return, then you are paying 18 lakhs during the 30 years, and you are earning 156 lakhs during these periods. That means further 5 years, 25 to 35 years, you are paying 3 lakhs, but your fund is growing more about 70 lakhs, 86 to 156 lakhs. It reflects that over the long run, you are getting more return because compounding helps you to grow your fund year after year. This is the magic power of compounding. Let us see with an example, small example, how it works in your lives. Say you think that you are investing only 9,000 in a bank FD and expecting 10%. That means at the year end you are getting 900 out of the 9,000. In the second year, this 900 added your principal and you will earn interest on 9,900. But how it will reflect? For the first 9,000 you are earning 900 and for 900 you are earning 10% is 90 rupees. In third year, you are earning 900, again 90, then 9. That means each subsequent years, your interest becomes the principal and you are earning interest on interest. The power, this is called power compounding. This is the graph for 31 years. The same 9,000 FD. You see, in the FD, this 9,000 become 7,538 after 7 years. See the graph, in the initial stage, there is not more return because you earn only 9,000 ka 10%, then 900 ka 10%. You see here the interest. 900, 990, 1089, that is 1989, and 1100, 1300, 1400, 1500, like this. After that, you see in the graph, 10 years onwards, it is dramatically changed. That means it become your interest, earn more interest as your rate of return is the same. What we learn from here, not only your interest rate create wealth for you, but time also a vital factor for your investment journey. If you hold 10 years, 20 or 30 years, due to the power of compounding, you will accumulate more wealth for your investment. As a result, you can achieve your financial goal, whatever you forecasted. In the 1st April 2003, if someone has make a SIP in Sensex 30 funds, index funds, and after 20 years, that means April 2023, it become 5.5 crore. One thing I have to mention here that in the earlier illustrations, what you see, your graph is very smooth, but here you see your graph is not smooth because Sensex is volatile based on the market conditions and so many factors. It may be off, it may be down. Due to the volatility and market trend, your Sensex graph is showing up and down. Here in the 2008, due to Lehman and others financial issue, market is going down. Again, here in the COVID period, sudden fall in the 2019. This is the market. Market depend upon the so many factors, geopolitical issue and your economic factors and your growth, market is. But overall, when you are investing for a long term, you are achieving a huge amount. And here, let's see how your Sensex give the return over the 20 years. First 7 years, 6 months, you are paying 45 lakhs, but you are getting, that means your fund is grow 1 crore. The rate of return per month is 1.58%. In the next 6 years, 5 months, you are paying again 38 lakh. The total investment is 83.50 lakhs. You are earning another 1 crore. Your total amount will be 2 crores. Continue further, 2 years, 8 months, you are paying 16 lakhs and your cumulative investment is approximately 1 crore, but your cumulative return is 3 crore. Your rate per month return is 0.96%. Over the 20 years, you are earning 20% CAGR in the market. In the Sensex, you can see, suppose you not making any SIP, you just put in the 1st April 2003, after 20 years, in the 30th April 2023, Sensex value is 64,718. That means annual growth is 16.08. That means you are not doing any SIP, just putting 3,278, that value becomes 64,718 after 20 years. In the past 10 years, the CAGR income of the Sensex is 11.13%, and last 20 year as of Sensex value of 28 December 24, your CAGR is 13.2%. What we learn from here that in the over the long run, Sensex give a decent returns to you. The equity has the potentials give more return on comparison to other assets, debt or gold. Thank you. This is the brief about investment product and power of compounding. If you have any questions, you can ask to me. I will try to clarify with a suitable example.
Sir,
Any
I would
question?
like to ask one question, sir.
Yes, Asutosh.
Sir, is there any plan in mutual fund which gives a guaranteed rate of return, like in FDs, it's around 7 to 8% guaranteed rate of return for a particular year. So, is there any plan in mutual funds which shows yeah, you will get a guaranteed rate of return? Like it's depend on the market, the rate of return in mutual funds is fluctuating. But if any plans which shows you will get such amount at dash rate of interest.
No, Asutosh, you see, mutual fund does not generate any guaranteed return. It is volatile. It is volatile. There is no definite rule in the market. You will get the stable rate, except bank FD and some bond. You will not get the. But somehow, if you want to secure your investment, you can invest in a liquid fund, which is investing in the treasury funds and like that, where you can get more than your saving interest, say 6 to 5%.
Okay.
But that is also not guaranteed. Suppose interest rate rise or fall, that value NAV also rise and fall. But long run, it is somehow by experience or somehow the data in the past returns, equity giving around 10 to 20% if it is a large cap fund, or if it is a mid cap fund, then it will 12 to 14%, or if it is a small cap, then it may be 16% to 20%. Like one thing you should be remember that the fund which generated more return during the correction, you will also get same type of loss. For example, suppose आपने इस साल 10% कमाया, नेक्स्ट ईयर 12% कमाया, 13% कमाया, नेक्स्ट ईयर 15% कमाया। जैसे कि लास्ट 4 साल से हम लोग देख रहे हैं कि 30% 40% मिल के फंड दे रहा है, लेकिन लास्ट 3 मंथ में इंडेक्स हमारा 10% अबाउट करेक्शन हो गया है, ये फंड भी आपको 10% लॉस दे चुके हैं। ओके, देयर इज नो गारंटी। आपको देखना है, अगर गारंटी चाहते हो देन यू गो टू पीपीएफ, दैट इज ऑल्सो नॉट गारंटी। एवरी क्वार्टर में गवर्नमेंट इसको नोटिफाई करता है, जो नोटिफाई करेगा वो रेट गारंटी है फॉर क्वार्टर। बट आपको कोई गारंटी, हाँ बैंक एफडी में आप कर रहे हो, आज फिक्स कर दिया 10 साल के लिए, वो रिटर्न गारंटी है। बिकॉज बैंक एफडी में एक बार आपने कर दिया तो वो रिटर्न आपका जब तक आपका मैच्योर नहीं होता है वो आपको गारंटेड है। बट म्यूचुअल फंड में कोई इक्विटी रिलेटेड इंस्ट्रूमेंट में मार्केट में कोई गारंटेड रिटर्न नहीं है। ये तो आप दिमाग में रख लीजिए। because we always
Okay.
say that equity has the potential to give return. That means more risks. If it is more
Okay.
risk, it is a greater, more chance of more loss also.
Okay. Okay, and I understand, sir.
Any questions regarding your compounding?
Sir, if I invested today, let's suppose if I started doing SIP for 2000 rupees only for a month, and I'm investing that fund for around 5 years.
Yeah.
What amount of money I can expect after 5 years
2000 per month you are make a SIP?
investing? Yes, sir.
Okay. How many years?
After 5 years.
After 5 years. That means you are
Yes, sir.
paying only 1,20,000.
Yes, sir.
Your return will be, if it is 12%, then it is 42,000.
Okay.
Or suppose I increase the rate of return 14%, it will be 50,000. Then your total value will be 1,70,000 because you are paying 1,20,000.
Okay.
Here Ashutosh, in case of SIP, for the first 1 year you will get the absolute return, and thereafter it will be compounded.
Okay. Yes. Right.
But because you are paying per month 2,000, that means you are paying 24,000 in a year, and 5 years you are paying 1,20,000. Over the five
Yes.
years you are paying 1,20,000. Your rate of return is 14%. Then you will earn only 50,672.
Okay, sir. Thank you very much.
थैंक यू. ये जो मेरा ये जो सीरीज है ये रहेगा डिफरेंट टॉपिक में है, और आप लोग को अच्छा लगता है तो आप लोग जुड़िए मेरे साथ. थैंक यू वेरी मच.
Thank you so much, sir. It is an excellent presentation. Dr. Mohapatra taught us many things that will help us build wealth and achieve our financial goals. The detailed analysis of Sensex returns and the magic power of compounding are eye-opening to all investors. Thank you.